Liberty Nation with Tim Donner.
Why are markets rallying in the wake of millions unemployed? That's the title of a piece by our economic maven at LibertyNation.com, Andrew Moran. The stock market dropped from close to 30,000 down to around 18,000 in the space of just over 5 weeks. That's a loss of 40% in just over a month. Shocking stuff. Tens of billions in lost value. But it's perhaps even more shocking that the market has, over the last 3.5 weeks, recovered half the value it lost. Here to explain it all to us is the man himself, Andrew Moran. How are you, Andrew?
I'm well. Thank you for having me.
Well, pleasure as always. Let's start with a simple question with likely a complicated answer. How can the market be holding steady when we've seen 22 million people, and that's just the unemployment claims, lose their jobs over the last month?
It's two things. The Fed has unleashed quantitative easing infinity. It's slashed interest rates to zero. Jerome Powell, he said that he's ready to buy anything and everything without a ceiling. The Fed is buying corporate bonds, it's buying junk debt, it's buying ETFs, buying municipal bonds, and everything else under the sun. The only thing that's left now for the central bank is sub-zero interest rates and buying stocks like China, Japan, or Switzerland. So when you have trillions of dollars pumped into the system, you stabilize everything. You give traders enough of a risk appetite to buy and sell. You don't have this chaos. You don't have mass liquidations going on every single day. And then the second issue is that markets are always forward looking. So when you saw that bloodshed that happened, as you just mentioned, it was all pricing in the chaos that was going to occur, that we're seeing right now unfolding. The historic jobless claims, the soon to be double digit unemployment rate, the depressing earnings seasons. You saw that happen just a few weeks ago when the first initial jobless claims number came in, and I think it was 5 million. It was just a huge spike, and the leading indexes, the Dow Jones, the S&P, they hardly reacted to it. So right now, the markets are just waiting to see if the coronavirus will extend into the summer or autumn. Everything else is just noise now to them.
Now, what's most noticeable to me in recent days, Andrew, is how we're not getting those wild swings in the market we were getting just 2 or 3 weeks ago. Up 1,000, down 1,000. One day it was down almost 3,000. That was truly chilling. Mm-hmm. Is this a sign, this recovery, is this a sign that the financial community is generally very supportive of President Trump's leadership in this crisis? Or is it just bargain hunters, bottom feeders, confidence in the federal bailout package? What?
Yeah, I don't think the market really cares what President Trump is saying right now. I think the only words they want to hear from Trump is that he's reopening the country, or he's going to keep it closed for however long period. So right now, again, it's all about the Fed. Everything else is what you're talking, and of course, everything else you're talking about. Investors searching for bargains and traders getting the bailout money, and airlines or automakers. But overall, it's just the Fed, the $2.3 trillion stimulus the other day, and then the other $2 trillion stimulus, and then the Fed buying all the bonds. It's all Fed intervention. That's everything that's driving this market right now, which is pretty dangerous for when this crisis does end. And then you have the other end of the lockdown, which could be the huge spike in inflation. When you have the Fed printing all this money, the freshly created money goes right to the two main beneficiaries, which are the Congress and the Wall Street. And then eventually, as time goes on, you have the freshly created money going throughout the rest of the system, and then every other American has the depreciated currency buying the highly inflated prices, whether it's the eggs or the stocks or whatever else that's in demand in the market right now. You saw that in the I wrote about it in my Swamponomics column the other day about eggs tripling in prices.
Now, Andrew, it's been said often that the market deals well with bull and bear markets. When the market's going up, people are optimistic, and the bear market is going down. They can deal with that, but they can't handle uncertainty. That's the one thing the market cannot bear. To what degree is uncertainty, as opposed to downright fear, driving financial markets these days?
Yeah, in the beginning of March, before the Fed intervened, that was one of the driving factors of the liquidation you saw with all those 1,000 point swings. That there was uncertainty among investors because they heard that the Fed kept saying, like James Bullard, he's the head of the St. Louis Fed branch, and he was talking about how there isn't necessarily a need for the Fed to intervene. And Jerome Powell, he was saying how they're just monitoring the situation. So with all this money that was being pumped into the system, everyone just wanted to dive into the U.S. dollar and get rid of their stocks and their bonds. And they just wanted to hold cash. But now you're seeing more of a certainty factor because the Fed is pumping all this quantitative easing into the system. So this is why a lot of the Wall Street investment houses, they say that once this coronavirus crisis is over, there's going to be this market euphoria that you experienced over the recent years, and that's even more pronounced now. All the Fed intervention is going to be bad for the average American. So there's going to be a massive spike in price inflation, but it's good for everybody else that's connected to the Fed spigot. Wall Street, Congress, Silicon Valley, all those power players.
Well, now you're talking about the eventual unleashing of this pent-up demand. But how quickly, Andrew, can the U.S. really expect to recover from the economic effects of this crisis when almost every other economy in the world, almost all of whom were not in as good shape as the U.S., will experience recession as well?
Well, I think it's going to be tough for the Main Street economy because for a long time, so many businesses and households were already in so much in debt, and they were hardly keeping their heads above water. And then the government, they gave everyone a lifeline, but that money will need to be repaid through higher taxes that eventually is going to happen in order to pay for all the spending that's going on. And then when you have higher taxes, that's going to hinder economic growth. Now, that said, I think that once a lockdown is over, I have faith in American ingenuity. Companies, investors, they're showing that they're coming to the game right now in the middle of a crisis, developing masks and, retooling their operations to help the healthcare workers and help, mitigate this crisis. So I think the U.S. will make do in the meantime and do what they can. The U.S. has done it before: the Great Depression, the stagflation of the '70s, the financial crisis a decade ago. So the U.S. has done it before and will do it again. So it will eventually be morning in America, and then followed by another steep crash, and then hopefully the Fed will just stand by, let the market take care of everything, and then the U.S. would be on a good footing again with all this debt and all this money printing and all this inevitable inflation that's going to happen.
Well, I would welcome, as everybody would, morning in America, Andrew, but I think we'd all settle for just normal life.
Yeah, and I think that if Joe Biden wins the presidency, if it is morning in America, I guess he'll just think it's evening in America because of his cognitive declines.
Now, Andrew, thank you for joining us.
Thank you for having me.
Andrew Moran, economics correspondent for LibertyNation.com. We'll take a quick break and come back with Talkin' Liberty.